Just now, silver was put in a new category as an important mineral. Now that geopolitics and tariffs are getting really bad, there is a lot of defense demand from Russia and China. Now people in the US want it. In a nutshell, that's why we're seeing record prices in every single global foreign exchange currency cross. This has caused the US to both stockpile silver and soon stop exporting it. Tightening supply can only lead to one thing. The price of metal that can be delivered right away is only going to go up. In a world where opposing monetary and geopolitical blocs are becoming more common, the fight for real estate has gotten worse in ways that haven't been seen since the 1970s. The way Russia, China, and India are aligned around real goods has changed the way global finance is managed. As these countries slowly become less dependent on the dollar, they are building up their stocks of gold, silver, energy, and rare minerals, which are real things that can be used as money. Western leaders are scrambling to find ways to use this coordinated reorientation to their advantage. To deal with this, the US has started quietly changing the names of key materials like silver to critical minerals. That one choice made by a bureaucrat means a lot more than just an administrative update. This shows that people are aware that silver's dual role as both an industrial and a monetary metal has become strategically important in a world where economies are becoming more divided. The math behind geopolitics is simple. China and Russia have already set up their commodity trade networks to avoid using the dollar. Instead, they settle in their own currencies and put more and more value in gold. India has increased the amount of bullion it buys, which makes it more connected to Shanghai and Dubai, which are the price hubs in Asia. In this situation, Washington is now facing a new truth. Silver has been a secondary asset for a long time, but now it is becoming an important part of both modern warfare and renewable energy systems. Demand is rising in defense, energy, and technology for everything from high-precision electronics and missile systems to solar panels and power lines. According to reports that Andrew Maguire cites, the US may have even started to store silver and may try to limit its exports. If that happens, prices could change right away in global supply lines. What this means for valuable metals is very important. In the past, silver has not been as well known as gold in terms of strategy, but that may be changing. The structure of the silver market, which has been skewed for a long time by synthetic paper trades, is starting to break down as governments in the East and West compete for real supply. Foreign currency prices have already reached all-time highs, which shows how cheap silver still is in US dollar terms. And these new prices won't be set by guesswork or emotional feelings, but by the hard math of lack. As limits on exports get tighter and demand from factories grows, the only thing that makes sense is a higher offer price for immediate delivery. This is the exact trend that Andrew Maguire worries about in his most recent report. This movie shows how this change is affecting the over-the-counter markets. It also talks about what it means for the credibility of central banks and why gold and silver may be entering their biggest revaluation phase in decades. What is it then? The Fed. That is the only central bank that still has a net short derivative book. We can see this clearly in the hard to high COMEX futures market footprints, where we can trace the monthly Fed payments back to the BIS, just like we have done in every other episode. However, we've managed to trap the Fed having to buy back their short-sold lease borrowings into a series of higher prices. Now, you're talking about the bigger over-the-counter, naked short unallocated bets in the UTC report. This is where the real problem with gold derivatives lies. Now, every physical liquidity provider we work with, who is well connected, backs up what we say and gives us solid proof that these very, very large, undeliverable, unallocated OCC gold bets are not real. Remember that OCC only refers to the report that the Office of the Comptroller gives. We've already shown how the 5-year and longer bets started to be cut down, which was another sign that someone wanted to get out of town. So these bets, which are still open, are really all that's left to hedge. These rehypothecated double ownership claims on an unknown percentage of the 8,133 tons of U.S. Treasury gold, or to put it another way, U.S. Treasury lease positions that haven't been paid back yet. We're going to get into the specifics of how exposed the Fed is to being forced to revalue gold. We're going to do that right now. But this is the spot market for the much more well-known COMEX futures holdings. We can compare this to the futures market, which is a lot like the stock market. Every month, we show how much of a hole the Fed has dug. This is best shown by the higher end of the month mark, and now it's the end of the third quarter mark-to-market event. Even though there was a huge push to get rid of as many spec longs as possible before yesterday's end of quarter, there was still an attempt to get rid of them. The Fed had to buy back gold leases that were heavily underwater at exactly $409 an ounce more than they could last month. This is meant to bring that down. Since there are still 30 tons to buy back at market, the price at which gold is being sold will go up even more. For that reason, if I'm the seller and I see that people want it, I'll raise the price. Right now, these 30 tons are pounding on the door of $4 billion. That's just to make these smaller plays on the future level, but this much physical buying at the market will once again show that the buyer is the Federal Reserve. This gets us back to our claim that the price of gold will soon have to be revalued against other currencies. The problem for the CML-BMA cartel is that the Shanghai Exchange international vaults are attracting legacy institutional ETF and physical flows that are not controlled by the West. This changes the balance between overvalued leveraged futures and underbought physical gold demand. And it's making this gap even bigger. The in-depth study by Deutsche Bank now looks at why ETF demand is beating all the old models that show overbought conditions. What isn't talked about is the fact that most of the institutional EFP investors who buy gold start out with no money committed to the trade. They've never been shown. They wouldn't have any gold in their account. They are beginning. This is very important. So, it's clear that they have to buy into the present physically determined benchmark positions on the Shanghai Gold Exchange. This market is on the side of Shanghai International that they are facing. This is why the aggressive meaning is given in this link. Also, we can see that China has a huge share of the gold market and is preventing ETF investment flows from going to the LBMA CME price setting machine. This very strong desire for physical gold is a big reason why prices are going up. That brings us to Lawrence's question about where we are with the process of revaluing gold, which was brought to the forefront in January 2023. As we all know, on January 1st, 2023, the BIS changed the classification of gold from a commodity to a high-quality liquid asset. Following the BIS's lead, every central bank bullion bank and new institutional exchange-traded fund gold moved to buy gold, leaving only one central bank short gold. If you like these kinds of in-depth looks, please subscribe, turn on alerts, and share the video so that more people can see what's really going on behind the news.